Have you ever really stopped and wondered how your bank actually makes its money? I mean, we all have a general idea, right? But the real story today is so much more complex and honestly, way more surprising than you probably think. So, let's pull back the curtain and take a look at the modern banking playbook.
Now, if your first thought was, easy, they take my deposits and loan them out at a higher interest rate, you're not wrong. But that's just one piece of a much, much bigger puzzle. The game has totally changed.
So let's start with the absolute basics, the foundation of banking for, well, centuries. The classic model is pretty straightforward. A bank borrows money from you and me, the depositors, at a low interest rate, and then it lends that same money out for things like home loans and car loans at a much higher rate.
And that difference, that gap between what they earn on loans and what they pay out in deposits, has a name: the net interest margin. For a very long time, this was the main engine of a bank's profit. The wider that margin, the more money the bank made. Simple, right?
Well, this is where our story takes a huge turn, because in today's world, that classic model is getting squeezed from every direction. And this pressure is forcing banks to completely rethink how they do business and, frankly, how they even survive.
So where's all this pressure coming from? Well, a couple of places. First, you've got falling interest rates, which shrink that precious margin we just talked about. And second, something that's changing absolutely everything: the incredible speed of technology, especially the rise of digital payments. Just get a load of this number. To run India's incredibly popular UPI digital payments network, banks are footing a bill of around 8,500 crore rupees every single year. And the government subsidy, it only covers a tiny fraction of that. This is a massive, ongoing cost just to keep the digital lights on for all of us. And this really gets to the core of the problem. A report from the fintech company Zeta just hits the nail on the head. Banks are paying for the whole infrastructure while other companies are getting all the benefits and, maybe more importantly, grabbing the customer's attention.
And this slide just lays it out perfectly. I mean, think about it for a second. How often do you open your main banking app? Maybe a few times a month, if that. Now compare that to a payment app, which the average person opens 25 to 30 times a month. The fintechs now own that daily relationship with the customer. So if the old model is broken, what do the banks do?
Well, their first big move was to double down on a whole different source of revenue: fees. The thinking is, if we can't make enough from interest, we'll make it by charging for all kinds of services. The industry calls this non-interest income.
And you can see that shift right here. This non-interest income, basically everything that isn't from a loan, now makes up over a third of a typical bank's entire revenue. This isn't some side hustle anymore. It's a core part of their strategy.
And I'm pretty sure you'll recognize a lot of these. You know, the little fee for swiping your card at a store, the charge for using another bank's ATM, those penalties if your balance dips too low, or even the commissions they make for selling you other products. Each one seems small, but together they add up to a massive new revenue stream.
But just collecting fees is only one part of this new playbook. The next step is even more radical. It's turning the bank itself into a kind of financial supermarket, using its brand and its giant customer base to sell you other companies' stuff.
A perfect example of this is something called bank insurance. It's a fancy name for a really powerful idea: a partnership where banks sell insurance policies right there next to their own savings accounts. They're using the trust you already have in them to become a one-stop shop for everything financial.
And this isn't just one kind of deal either. It can be super simple, like a bank just referring a customer for a quick commission, or it can go all the way to a full-blown joint venture, where the bank and the insurance company build products together and share both the profits and the risks. And the reason banks are jumping on this so hard, well, the numbers speak for themselves. The bank assurance market in India is already worth a massive $105 billion, and it's projected to basically skyrocket to $180 billion in less than 10 years. This is a huge, huge growth engine for them. Okay, so we've got banks as lenders. We know they're now fee collectors and financial supermarkets. But there is one more, often hidden role that can be incredibly profitable: the bank as a massive market investor, which they do through their treasury operations. So as this quote from Mint points out, when the economy slows down and not as many people are taking out loans, banks have these huge piles of cash they need to put to work somewhere. And one of their favorite places to park it is in government bonds. Now, this is where it gets a little weird, a little counterintuitive. Imagine a bank owns a government bond that pays 5% interest.
If the central bank then cuts rates, new bonds might only pay, say, 3%. All of a sudden, that old 5% bond looks way more valuable, right? So its price on the open market actually goes up. Banks that hold billions in these older, higher-rate bonds can then sell them for a massive profit.
And believe me, we are not talking about small change here. Case in point, Punjab National Bank recently made a staggering 1,000 crore rupees in a single 3-month period, just from these kinds of treasury trading profits. It's become a major, if sometimes unpredictable, source of income.
So when you put it all together, what have we actually learned? It's clear that the quiet, simple bank from back in the day has morphed into something way more dynamic, way more complex. Let's just quickly recap what the modern bank's playbook really looks like.
Your modern bank is still a lender at its heart. That part hasn't gone away. But on top of that, it's also a fee collector, a financial supermarket, and a shrewd market investor. It's basically playing 4 different games at the same time, all just to stay ahead in this incredibly fast-changing world.
And all of this leads us to one final, really important question. We've always trusted banks to do one simple thing: keep our money safe. But as your bank evolves into this complicated mix of a lender, a tech firm, and a retail store, what does that do to the future of our trust? It's definitely something worth thinking about.